okay, what the F is this guy smoking? Because let me tell you, this has got to be the craziest headline I have seen on a clip from CNBC in a very long time. And this is a very respected individual on Wall Street. This is Jefferies David Zervos. This says on the August jobs report that came out on Friday, 20,000 jobs lower than expected, unemployment rate that went downwards, but not as much as expected. The unemployment rate actually went from 4.26% down to 4.22%. Big deal. It's like we barely got a rounding, lower jobs report. Long story short, he says, you're going to laugh at this. He says it wasn't bad enough to get us a good reaction. Oh. If this is what Wall Street is thinking right now, yeah, we're screwed. We're screwed. Like, I'm not actually going to play this clip because I think it would waste your 4 minutes of time out of your life. And I don't think that makes a lot of sense because the markets want a good jobs report. If we had 200,000 plus jobs, the unemployment rate went down an actual 1/10%, like 0.10%. Like if we went from 4.26% unemployment down to 4.16% unemployment, markets would have soared like nobody's business. A good jobs report is good at this point. A bad jobs report is bad at this point. We're back to normal. Normalcy is, well, too far-fetched for Wall Street these days. I mean, I guess I just felt like starting this video with that because I think that in a nutshell kind of shows you where Wall Street's at right now. Some people are in Delulu land, and I love the Bulls and I love the Bears. And when I'm bearish, I like to, challenge my opinion more on the Bulls side. And when I'm too bullish, I like to challenge my opinion on the Bears side. And well, there's not a lot of challenging right now for the Bear side. There is a lot of things that are working against us in markets. September is seasonally the worst month for stocks. Normally, over the last 10 years, by far, September takes the cake. It's bad. October, though, during election years, tends to be even worse than September. And that's not a good position to be in when you had a bad jobs report on Friday, when you're getting some really mixed bad data. For an example, take a look at job openings in the construction sector. Ever since February, they have started to fall with a little bit of a rebound from April to May, but from May until today, they're really starting to collapse now, something that you normally see during recessionary environments. Or what about this from the Wall Street Journal that said, quote, using a 3-month moving average to smooth out this and other monthly volatility, the underlying trend is clear. The economy added an average of 116,000 jobs in the 3 months through August, down from 141,000 in the 3 months through July. In fact, this average has been moving downwards for 5 straight months. There's no doubt about it. Things are weakening at a pretty aggressive pace at this point. Or what about this? From the Kobisi letter, job cuts at U.S. companies jumped 193% in August to 75,891 from 25,885 cuts announced in July, according to the Challenger report released Thursday. A lot of, Wall Street tried to write off the last jobs report that we got, not the one that just came out for August, but the one that came out for July, to say that, well, we just got the rise in unemployment because more people entered the workforce, and the Hurricane Beryl in, I believe that was June, affected the numbers. And that's a really hard argument to make with the data that we got last week. I mean, if you actually look at this chart, This November 2022 prior high was like 155,000 challenger job cuts. We're at 175,000. So in fact, this is actually not, updated. This would be literally off the charts and to the right if this was an updated chart. Way up here at 175,000. Well past anything you've seen at the end of 2022 when a lot of people, a lot of firms, a lot of companies thought we were actually heading into a recession. Now, this is also pretty troubling. It says here, ChatGPT website visits are apparently collapsing, according to data from SimilarWeb compiled by Goldman. Is this why they were considering the ridiculous $2,000 a month subscription and desperately trying to raise funds before the large language model bubble burst? I do think LLMs have potential, but I also think that their capabilities have been massively overstated in the here and now. We're at the peak of inflated expectations, and that's exactly what you see here is going from 1.8 million visits a month, 1.8 million visits a month. That could be 18. Is that 18? 18 million visits a month. Yeah, 18 million visits a month. Down to like 200,000 visits a month, 2 million visits a month. It's kind of weird how they have this chart. Usually charts like this are in thousands, maybe down to 2 million visits a month. This thing is collapsing. I mean, maybe that's why you're seeing AI stocks not doing well. That could make a lot of sense. The point is I'm trying to make here is there's not a lot going for markets in the near term. September is a bad month. October during election years is a bad month. We just got some pretty mixed downwards tilting data. And September, has already started off on a bad note. We're heading into the first Fed rate cut, September 18th. And most of Wall Street right now has the mentality of, you should sell the first cut because, in fact, the Goldilocks period during Fed hiking cycles and then cutting cycles is actually after the last hike, but before the first cut. So the last hike that we seen was July of 2023. We've had 14 months of this Goldilocks period, and we've seen what stocks have done. They've done very well. Now you're heading into the first cut from the Fed, and that's usually a moment in which you want to fade that. You want to have some protection on your portfolio. You want to be in more cash than maybe other times you're normally not. And again, most of the time, stocks sell off after the first cut from the Fed. That's what a lot of Wall Street is starting to say now is stocks can actually fall after the first cut from the Fed. And that is coming right around the corner. Right around the corner. It is September 8th. Tomorrow is September 9th. The Fed cut is literally 9 days away, less than 2 trading weeks away from today. I'm not that optimistic in the near term for markets. I also see a big disconnect, like a massive disconnect. I've never seen anything like this, to be honest. And I've been in the market since 2016, 2017. Started to, really get into markets around then, where you have an economic outlook that does look more negative now than it did before. But the market's just unwilling to price in any downside potential, any chance of a recession, or any chance of EPS that comes in a little on the light side. Like earnings estimates are at all-time highs still for 2025. That is a little ridiculous, okay? Because the upshot there is what? If we're pricing in 15% EPS growth for 2025, you need like 20% EPS growth for 2025 to impress investors. That's crazy. If you're thinking about the S&P 500 as a whole grows EPS by 20%. Like, seriously? With the economic data that we're seeing, it's not like we're money printing right now. Things are not very accommodative, to say the least. We're 225 basis points in restriction if you judge neutral at 3% for the federal funds rate. Like, that's really the backdrop? You want to be expecting 15 to 20% EPS growth for 2025? No, even a lot of bullish fund managers recently have said earnings estimates are too high for 2025. And we're going to take a look at this clip that from CNBC that basically says the same thing. Take a listen to that now.
In fact, in about a year and a half, NASDAQ taking it on the chin today. It's on track for its worst week since January of 22. Joining me now, Post 9, Morgan Stanley's Chris Toomey. Welcome back.
Thank you.
All right, what's your take?
Look, last time we were here, economic number was kind of in Goldilocks view situation, which was giving the Fed exactly what it wanted to do. What we saw was a situation where prices had gotten way ahead of themselves. We thought we were probably experiencing a situation where something was going to have to pull this back. We got a bad employment number at the beginning of August, then we got some decent numbers in between. But I think the big thing that's changed is bad news is bad news, right? Like, it used to be bad news is good news, now bad news is bad news. And the other thing is, good news is not great news, so good news is now bad news, right? So you had...
Is good news bad news? And I would take issue in even some respects that what we've gotten is quote unquote bad news. We're acting as if the economy is in some tailspin. The data would suggest otherwise.
I think the data is, if you look at earnings are actually okay, right? The Mag 7 numbers, the most recent one, was actually not bad. I mean, the question is that, everything is priced to perfection. And if it's not great, it's got to be bad. The employment number today, you've got Steve Leisman on all the time. He looked at it first thing and he said, it's not bad, right? But the market's acting like it's horrible. And so I would say the economic data is not bad. I think the economic data is fine. I think the pricing was off, right? So the pricing's come back.
I don't even know if the market is taking it like, oh, the data was so bad. I think we're starting to get into a conversation as to whether the Fed is going to blow it or whether they already did.
No doubt, right? Because, the thing is, we're in a situation where they've kind of thread the needle here with regards to kind of moderating growth, bringing down inflation, raising up unemployment, and the market's been doing well. But the problem is that, we're at an elevated place for rates. We were just in a period where we had 15 years of zero interest rate environment, and there's about a 6-month drag before they start cutting rates, right? And so you're in a situation where markets are priced for perfection. They're expecting the Fed to continue to be able to defy gravity, and maybe that's not going to happen. And so that has to be priced into the market.
All right, so we recalibrate. We need to recalibrate.
Absolutely.
But that doesn't mean we need to completely fall out of bed either.
Well, you know what it is. It's stairs up, elevator down, right? So the market gradually goes up. It keeps kind of getting into this positive feedback loop of everything is going to continue as it is. And then all of a sudden it's like, wait a second, this isn't happening. And we get the elevator down, right? And so that's the reason why you have to be cautious when the market moves as aggressively as it has without any of these pullbacks.
Part of your point, again, it's like parts of the market took the stairs up. Big tech didn't take stairs up. They took a rocket ship. And now they need to come back down to earth a little bit.
That's right.
The problem is we don't know how much.
Well, I think we do. Look, if you look at it from a pricing standpoint, you've got rates coming down, so the equity risk premium is actually becoming a little bit more attractive. You're in a situation where they're continuing to provide great earnings. In our view, it's a situation where you still want to own these names. You just want to own them at the right price. And so in our view, market had to come back a little bit. You were going to expect to see the Mag 7 get hurt and drag the market down and all the other names that have been benefiting from it over the last 18 months. And now's the opportunity where you can start looking selectively at opportunities, whether it's in the 493, right? Or looking at some of these Mag 7 names and saying, look, I didn't own these names when they were at this level, but now they're at a more reasonable level. We can start owning these things.
Is that what you're thinking about?
100%.
For your clients?
Absolutely. So, look, we've been waiting for this pullback. We've been sitting on cash. We've been collecting the types of income that we like to collect, but we thought the markets weren't really justified with the right type of risk that we're in there. And so that now the prices are coming back, we're getting a little bit more interested in putting some money to work.
Interesting. So you thought the price was wrong. Now the price looks a little better. You're also implying that you don't think the the pullback goes much deeper than here.
No, I think it could. But that doesn't necessarily mean we're going to try and call the bottom. What we're going to do is we're going to look and see where the valuations are, how this fits into clients' portfolios, and we're going to start buying the names that we really like, that we think we can get at good prices.
How are you looking at volatility? VIX up 14% today, right? It's north of 22, and then election risk, 60 days away.
Right. So, I mean, look, I think people have talked about, I don't know if you know this, but September's not a good month with regards to investing. Elections also can be a problem for investing. And so in our view, that increased volatility is what we love. We like to take advantage of it, whether it's buying names that we think are unduly getting penalized or just writing call options on it and collecting extra income. So we like this volatility. We think it's going to stay. We didn't talk about this. I think one of the most important things that has been going on in the market is the buyback situation. So buybacks tracking almost 2 to 3 times than it historically has. That's going to end at September 13th once we go into earnings. So that's going to be another wave of problems that we see going into the next couple of weeks. So in our mind, we're not rushing into the market. We recognize this is probably going to continue for a little while, but this is giving us a good opportunity to add some money.
All right, this is a good place to leave it. It's good to see you again. Chris, thanks. This is Chris Toomey, Morgan Stanley, joining us here at Post.
I actually really like that perspective, so I wanted to share it with you. I agree with a lot of what he says. Now, again, if we go into a recession, if the data gets worse, that's really going to dictate where markets go. But I do think there is opportunity out here. Do I like big tech? No. I actually like NVIDIA more than I like Apple or Microsoft or Google or Amazon. I'm cozying up to that one a little bit. But, Amazon, specifically NVIDIA, I actually think those names could be decent for the next 12, 24 months of returns, okay? They're not priced for perfection anymore. They're still up there, but not as priced for perfection. Let me know what you thought about that clip down below in the comment section. Do you know a stock that is absolutely, under no circumstances, priced for perfection? That is Tesla stock. And yes, as I have explained many, many, many times now, we have election risk, we have the first Fed cut risk, we have September, October seasonality risk, we have a slowing economy, we have earnings estimates at all-time highs, we have markets that seem unwilling to price in any chance of a recession, let alone actually price in a recession, but to move from 0%. Can we just price in 10% chance of a recession? That seems almost impossible from the markets with every data point that we get that is recessionary or suggesting a recession is possible. We're just not pricing it in. Yes, there's a lot of risk in that sense from a lot of different areas, but Tesla is accurately reflecting that. And I think any lower that Tesla goes from here, if we go back sub $200 per share in September, if we go back to the 150s or, anywhere close to that range, let alone below that, markets are going to be in a really bad place, by the way, if we're below 150. But, especially with the Robotaxi event on October 10th, I truly think this is one of the last great buying opportunities, if not the last great buying opportunity for Tesla. The Fed's going to start lowering rates. That's going to be instantly accretive to Tesla's profitability because they're going to have to buy down less interest rate, okay? And it makes Tesla more attractive, right? The equity risk premium, was that Morgan Stanley's analyst there in that clip says, for so many different reasons, rates are good going down for Tesla stock. I don't even want to get into that whole spiel. We understand why rates going down is positive for Tesla. If we just get a better buying entry point for Tesla over the next couple of months, you should welcome that. I think most of you guys are savvy investors. You would welcome that, even if that means you can buy 1 share of Tesla every 2 weeks. And you're going to get 5 or 10 more shares of Tesla. I think you should welcome that in the longevity of your investment portfolio. Hopefully you're not investing for 3 months. Hopefully you're investing for 10 years, 20 years, 5 years at least. And I think you will be heavily rewarded for taking advantage of what we're probably going to see over the next couple of months, which is more weakness and more downside for markets, generally speaking. Now, just to give you a brief rundown of what we have in store for us this week. On Monday, you have the consumer inflation expectations. I'm not expecting that'll move much at all. You do have wholesale inventories month over month. That may be important because, as you can see here via the Atlanta Fed GDP Now tracker, we'll get a new GDP update coming Monday. Current estimates are at 2.1%. Those wholesale inventory numbers will move those estimates, so keep that in mind. If we get a big, surprise in either direction, it could move estimates for GDP a little bit more, which could have an effect on markets. So it's possible, improbable that it will be something important. Tuesday, you get core inflation month over month, expecting 0.2%. Year over year, expected to stay the same at 3.2%. And inflation headline month over month, expected at 0.2%. You also have year over year headline expected at 2.6%, down from 2.9% last month. Again, I don't think inflation is a catalyst anymore for markets. As long as it just comes in low or in line with estimates, I don't think we're going to get much of a market reaction based on that. Obviously, if it comes in higher than expectation somehow, we're going to get a negative reaction. If it comes in a little bit lower, maybe we get a positive reaction until it comes in too low. Like if we start to get negative month over month numbers, Wall Street's not going to look at that as positive. Wall Street's going to say, oh shit, that's bad. The only thing worse than inflation is deflation. Deflation means companies take in less revenue, companies can employ less people, people get laid off, and you can actually see a bit of a race to the bottom in certain categories as companies just try to survive and cut workers and try to survive and cut workers. And obviously, what does that do to the generalized economy when you see deflation is you get less jobs, you go into recession, less spending. It's just a terrible cycle to be in. And that usually only happens during deep recession. So I'm not expecting deflation, on a prolonged basis. But if we do get some signs of deflation, don't think for a second that's positive. That will come with aggressive Fed cuts. That will come with quantitative easing. That the Fed will do whatever they have to do to make sure we don't go into deflation, because that means guaranteed recession. Thursday, we're going to have PPI month over month, expecting 0.2%. Last month was 0.1%. Really don't think that's a big catalyst. We have initial jobless claims as well, expecting 231,000. Last week was 227,000. So expecting a little bit of a move higher. Nothing really besides that on Thursday. On Friday, we will get Michigan consumer sentiment. You really want to watch current conditions and consumer expectations. So current conditions are the one that looks really bad. You are at a 12-month low as far as the last number that we got for August, and you're overall not sitting in a good place. You've kind of been trending lower for a while now. But ever since about March or so of 2024, you've really started to decline. You went from 82.5 points down to 61.3 points. Current economic conditions, do not look good. The other thing you want to see is consumer expectations. This looks a little bit better. There has been a rise from November of 2023 levels, but I think this really revolves around equity markets more than anything, because it just tends to revolve around equity markets, I think, and the sentiment around stocks, largely speaking. You're not back to where you were pre-pandemic. 2019 levels were around 92 points. Today, you're at 72 points, so you're still down quite a bit. And if we do get a move lower there, obviously markets are not going to like that. So that can be a big catalyst. Coming Friday, I will expect a market reaction. But really, if we want to boil this down, the first cut coming in 9 days from now, less than 2 trading weeks. Heading into Q3 earnings, expectations look high. We're not pricing in a recession. We seasonally have a bad September, an even worse October during election years. You have election uncertainties that need to be priced further into markets. There's not a whole lot here to go off of if you are a bull. And I find it alarming that a lot of folks on Wall Street are saying, this is still a bull market. And of course, it can still be a bull market, but we have real risks that threaten to derail that nobody's going to talk about until we're actually out of a bull market, until we're actually like full on correction mode. That's when everyone wants to get super bearish all of a sudden. I wouldn't say I'm super bearish, but I'm definitely not bullish. Definitely not bullish. Not by any stretch of the imagination, at least for the next 8 to 12 weeks. And I know that's only a 3-month short-term call. If you're a long-term investor, dollar cost average into your favorite stocks. If you're a little more savvy and you pay attention to markets and you're watching this video up until this point, then I think waiting for a better buying opportunity on Tesla makes a lot of sense. Waiting for a better buying opportunity on Nvidia or, broader markets makes a lot of sense. Sure, is there opportunities now if you want to buy some things? Of course. Dollar General, it's fell a lot recently. I know I'm going to get hate down below in the comment section for that. I don't think the stock's going anywhere. I think it's going to do well in coming years. I think that could be attractive. High quality, high paying dividend stocks can be attractive at current levels. Are they going to fall more? Probably. Are you going to catch the bottom perfectly? Probably not. And I think you do want to nibble on some things here, but you want to stay nimble and you want to be ready for what could be more weakening. So these are just my thoughts. Who knows? Let me know what you guys think down below in the comment section. Hit the like button as well as subscribe to the channel if you have not done so already. You guys have a great rest of your day, and I will see you in the next one.